Discover the story of a finance and accounting journey that started as a safety net but ended up revolutionizing an industry. Join Jody Grunden and I as we delve deep into the unexpected twists and turns of his path to empowering small business owners. Uncover the secrets to maximizing profits, minimizing taxes, and increasing cash flow that Jody has mastered along the way. Are you ready to unlock the next chapter in your financial success?
Welcome to Biz Help For You, the show that saves you the expensive learning curve by providing advice from industry experts in every facet of the entrepreneurial journey. Too many small businesses collapse. According to the U.S. Census Bureau, 20% fail within their first year, and less than 35% make it to their 10th anniversary. The goal of this podcast is to change that statistic. So if you're interested in learning more to be a successful entrepreneur, tune in today.
Now, let me tell you a little bit about my guest today. Jody Grunden, a seasoned accounting professional with over 2 decades of experience, stands as a trailblazer in the industry, known for spearheading innovative changes, such as introducing the first subscription-based billing method in accounting firms. His authorship of books like Digital Dollars and Cents and Building this Virtual CFO Firm in the Cloud underscores his expertise. As an entrepreneur, you can gain substantial benefits from his remarkable journey. Grunden's visionary leadership and the success of Summit CPA Group is the first fully distributed accounting firm in the U.S., can serve as a source of inspiration and guidance, particularly in adapting to evolving business dynamics. Furthermore, his proficiency in virtual CFO services, creative agencies, and remote team management can provide invaluable insights for entrepreneurs like you, aiding in the optimization of financial processes, fostering innovation, and enhancing remote team management, all contributing to your business's growth and long-term sustainability. So, Jody, welcome to the show.
Yeah, thanks, Candy. Appreciate you having me on.
I am looking forward to this topic because, of course, I do a lot of the things that you'll be talking about too, which I don't always talk about on my show. But finance is obviously important to entrepreneurs as well. But before I get into questions that I have for you on the topic, I'd love for you just to share a little bit about your story and how you became involved working with entrepreneurs.
Yeah, great question. I can actually start back to college if you want. And with college, I decided to go with an accounting degree. And I thought, hey, if accounting doesn't ever work out for me, I can always fall back personally on taxes and stuff like that. And I thought, hey, it's either that or a finance degree. And I thought finance would be great because if it doesn't work out for me, I can, again, help myself out financially. And so it was one of those, safety net type of things. I thought, hey, this would be a great opportunity to really help myself, but then also, apply it to work. And so the first job I got out of college was with a really large CPA firm. And I realized that I love the meeting with different clients and having, 10 to 15 different clients working with all the time. What I did hate about it was that the traditional CPA firm, we worked a ton of hours. Now, it was pretty common for me to work 80 hours a week from January through April. And I that just wasn't long-term for me. And I knew that pretty quickly. I was missing, kids events, family, super important to me. And it was just not something that I could see doing long-term.
Right. Well, obviously looking at financial information is important. And that's one of the things we want to do too, is share with our clients the financial information. But a lot of times they don't understand it, or they don't know like how to use the information in terms of metrics. So I'd love for you maybe to talk about some of the metrics that maybe entrepreneurs should be focusing on when they want to be growing their businesses, and how do they really measure that information?
Yeah, the one metric that I say that all entrepreneurs really need to know and really need to have, more so than really any other, is their cash position. And that metric is, we always tell clients, you want to have at least 10% of their annualized revenue in the bank at all times. That equates to about 2 months worth of expenses. If you really want to be conservative or risk adverse, then you want to be closer to 30%, which is about 6 months. So between 2 to 6 months. Now, if you do the math, there's a formula, there's a cash flow formula that goes through that, and it equates to roughly 10% to 30%. And so, again, those are the two metrics. Now, why do I say that? And the reason I say that is because The advice that we would give is depending upon how much cash you have in the bank. And it's kind of funny.
Okay.
We can have two companies that are side by side, the same opportunity. And I would tell one company, absolutely not, and tell the other company to jump on it like crazy. And that's because the cash position they're in. Because the more cash you have, the more risk that you can take. And that's the key. So like, for instance, the biggest thing is we get to a point where a lot of our companies want to say, hey, I really need somebody to do sales for me or business development. I'm tired of doing it myself. I'm the owner. I'm tired of doing it. I want to hire somebody to do it. Well, if they've got a lot of cash, if they got that 10% or 15% or whatever that might be in the bank, I'm going to say, yeah, it's a good risk to take. I think you can definitely do it, knowing that it's going to take a little bit to build that person up, to bring the revenue in, and knowing that there's going to be a cost associated with that. If you got 5% in the bank, or maybe even less, there is absolutely no way I would advise you to hire that salesperson. I'd say that's got to be your job until you bring it up to that 10 to 15%. And that goes with really every recommendation that I'd make. There's a lot of metrics we could talk about, Candy, but the biggest one is that cash position. That holds true, especially for those companies that are under $1 million in revenue. Even more so with companies that are over, you get bigger and bigger and bigger, and that cash position goes. Because keep in mind, a $1 million company needs $100,000 in the bank. A 10 million company needs $1 million. And so
Right.
the money grows as your revenue grows in there. And so that's the key metric that every business, no matter if you're a plumbing company, if you're an electrician, if you're a beautician, it doesn't make any difference. It's all agnostic. You need to have that 10% of your annualized revenue in the bank as a bare minimum.
Right. Well, and I think sometimes business owners get confused between cash flow and profit, right? If they're looking at financial reports, they're looking at the profit and they're saying, wait, why does my bank account not match what the profit is? And they don't understand that. So do you want to touch on that and how they can really make sure they're monitoring that accurately?
Yeah, the key there really is just understanding and meeting with your bookkeeper, your accountant on a regular basis, and really letting them tell the story, because profit very rarely, because of all the different accounting rules, very rarely equals the amount of cash that you're going to add to the bottom line at any particular time period, because it's based on timing issues of when revenue gets recognized, when an invoice gets sent out versus when an invoice gets paid, and that sort of thing. And so the key there is that when you're meeting with your bookkeeper or your accountant, you want to make sure that you understand the cash implications of that. And that's why it's really important, maybe not to understand what the cash flow statement looks like, because even accountants don't understand what a cash flow, for most of the part. Some of them do, but a lot of them don't even understand what the cash flow statement means. But the biggest part is you have to understand what the inflows and outflows mean and make sure that you're talking about it on the same thing. And that's why when I mentioned having that 13-week cash flow, the actual cash flow projection set out to where you can actually see exactly the inflows and outflows coming through. That's more important than understanding what the profit margin is at the very bottom there. And the reason why I say that is because the profit margins, they're designed to determine what your tax position is going to be in a lot of cases. And that's great, but that's not going to really help you manage that company. And so that's why we actually started presenting, instead of just showing a cash flow statement, we actually showed them, hey, here's the 13 weeks cash flow. Here's what that's going to look like. And it was always looking forward versus looking backwards, because a lot of times we get so excited as accountants to present a financial statement and talk about the history of the financial statement and what happened and all that kind of stuff, where in reality, the client's now living in the future. And so that's why it's so important that we quickly take that information and show them how that impacts going forward. And that's really the key. I think that's the biggest service that, as a bookkeeping firm, as an accounting firm, that we have to kind of change the way that we're thinking and provide that forward-looking insight as much as possible.
Right. Well, and you were talking, obviously, cash flow is really important and, profit is important as well, but that shouldn't be
Yep.
the key focus. So do you want to maybe even talk about how, if you are maybe a little bit strapped for cash, that you might want to offer some incentives for early payments from customers, and why you don't need to necessarily focus on getting that full amount for the bigger profit, when that can help with cash?
Yeah, so it's kind of funny you mentioned that because that's why I created the subscription-based billing model way back when. Because 20 years ago, when I started the company, we were living on credit cards. Credit cards. That was how I started it. That was how I funded initially. And what happened was is that I realized pretty quickly that I couldn't be the bank. The bank. It was tough being a bank for your clients.
Hmm.
They would pay 45 days, they'd pay 30 days, they'd pay all over the place. When you're meeting with them, that would be a conversation you'd have every single meeting. Hey, I need you to catch up on the two payments, or when you're going to be able to make that payment. The meetings became more of that. And then people would avoid me if they a couple months behind or a week behind or whatever. They wouldn't show up to the meetings, and they knew because they felt guilty that, hey, I haven't paid you yet. And so
Hmm.
it was one of those things that we thought, well, how can we actually figure that out so that it was productive and we weren't the bank? And that's when we decided, you know what? Every single month, we're going to zap your bank account for X amount of dollars. And for us, it was nice because we created that product, the service-based product there where we knew the exact dollar amount. For others, it could be a portion of it. It could be, 50% we're going to hit you every month. And then for the difference, if it's billed hourly or whatever, we can hit you for the difference. But coming up with creative ways in order to get money is really important because, you don't work for free. And if you're going to lose clients because they're not paying, they're not the right clients.
Right.
You need to be able to work with clients that are willing to pay you for what you're doing on a timely manner and get rid of the clients that don't. Now, doesn't mean get rid of all your clients because you have to have clients, but what it does mean, it means that you have to make sure that you don't just simply feed the beast all the time. You've got to figure out a solution to get around that. For our solution was, hey, we're going to charge you weekly and we're going to zap your account. It was monthly originally, now it was weekly. Zap your account every week. If you don't want to be part of that process, well, then you're probably not a client that we want to take on. And did we go back and fire all of our clients that we were billing hourly and doing all that stuff beforehand? No, we just gradually converted those folks over. But every brand new client we picked up, here's the new way we're doing it. And it was
Hmm.
kind of funny because we had zero pushback from all new clients. They're like, oh, you charge weekly. That's interesting. Okay, great. How's that work? Well, you fill out this thing, you zap your account every week. And unless the scope changes, it's going to be the same dollar amount until the end of the year. Then we'll have a fee increase at the end of the year. And we talk how it worked, and they're perfectly fine. Now, for those clients, kind of addressing the question you had there, for those clients that you have billed out and they are behind on payments, if they're 90 days behind on payments, it's good to get something versus nothing. And
Hmm.
because the further they get behind, the less chance you're going to get anything at all. So I would do whatever I can, give them whatever discount you can just to get them all covered up and paid. And then for those that are 90, let them go.
Hmm.
Don't, once they're paid and taken care of, you don't need that anymore. Let them go or set them up on a regular weekly, monthly bill where they're actually paying as agreed upon every single month. Because you don't need to deal with that as a business owner. You need to deal with other things, not collecting payments. For
Hmm.
those that are within that 30 to 90 and you want to give them a 2% to pay early or 1% to pay early, cash in the pockets, is worth more than that 1% you might be getting. And so I would
Hmm.
definitely take cash at any time I can, because again, you can't spend accounts receivables. You can spend cash.
Right.
And you can build your company
Right.
with cash, not what somebody owes you. And so it's super important to get your accounts receivable under control, whether that's giving significant discounts for those that are over 90 days just to get them off the books and then never do business with them again, which is kind of a hard thing to do because you're thinking, well, I've got to chase this revenue thing. And the revenue
Hmm.
thing makes no difference. You can't chase revenue if they're not going to pay you. That doesn't
Right.
make any sense at all. Why
Right.
waste your time? Why waste your efforts? Let's put your time and efforts towards the folks that are willing to pay you, and then just create that going forward. Hey, here's the new model we're using going forward. And I guarantee you're not going to lose clients. It's just a different way of doing things. If they want to do things, if you're attracting clients anyways, they will adapt to how you do it. And that goes from construction, that goes from really anything. I can't imagine walking into a Wendy's nowadays and saying, you know what, hey, I want that cheeseburger, but I'll pay you in a month. You know,
Right.
that doesn't happen, but it
Hmm.
could have happened if that would have been the way that they would have done it way back when they started. But they
Hmm.
didn't. They say, hey, here, you get paid for the product and the service at the time of delivery. And I would try to do that as often as you can.
Right. Well, even those who maybe are still invoicing and maybe their customers aren't even really late, like the 60, 90 days, maybe,
Mhm.
they're still paying within
Yep.
terms. I think
Yep.
there's two things you could do though. You can incentivize to pay early to, like you said, have that 2% or 1% or
Mhm.
whatever that might be. But for
Yep.
those who maybe pay a little bit late, have a little bit of a finance charge, right? So if they know like, oh, I have to pay
Sure.
extra now, I think that also does help. But I find one key factor too, and I've talked on this a lot when I've said, mistakes business owners make and what they should do to avoid them.
Mhm.
I think not putting themselves on their own schedule to invoice their clients consistently is a problem as well. And I would
Yep.
love for you maybe to talk about that too is, don't wait, and forget, like, oh, I'll do it when I get to it. The project's over, but, I'll get to it next week. I've got so much to do, right? Why that's not a good idea.
Mhm. Yeah, attorneys do that. They're guilty of that big time. If you ever work with an attorney, you'll forget about whatever the service they gave you. Then about 6 months later, you get this giant bill. It's like, oh, and that bill consists of about 6 months worth of stuff because they
Hmm.
didn't do it. And you don't want to be that person because then that bill becomes a point of contention. It's not like, oh wow, the service is done, thank you, and hey, oh, I'm willing to pay you. Now it's like, wow, this got this big bill, and you're creating animosity really between your client and you, and not even really intending to. It's like it's showing the client there's a lot of it's showing the client that you don't have your stuff together. If you're running a tight ship, the client would understand and you would understand that, hey, as soon as the service is done, you send the invoice out. You get paid within X amount of days, and the client sees that you're getting paid. You're doing it 6 months. It kind of puts a lot of doubt into what
Hmm.
the service you're providing. So yeah, it's super important to be consistent. And that's really the key. And whether it's you doing it or you're hiring a contractor to do it, whether that's a bookkeeping firm or accounting firm or just simply a contractor that you find on Upworks, it's important to have it done on a regular, consistent basis, whether it's every Monday or every other Monday or whatever that might be, so that bills go out. Don't think that you can't send the invoice out until you're done with a project, especially a project that takes that's extended over maybe a month or 2 months or something like that. Send out sprint bills. Send out bills
Hmm.
every 2 weeks. Progress bills every 3 weeks. Whatever that might be, just so that it's a consistent thing going out to that client. Because again, cash is what makes your business go around. That's why you're in business, is to build cash. And if you don't have that cash, it's really hard to do a lot of the cool things that you want to do in your business. And so that consistency is the biggest thing. Again, whether you do it personally, like if you know that
Hmm.
you're just not that person to do it, have somebody else do it for you. And that could be somebody internally in your business. That could be a contractor, like I mentioned, or it can be a bookkeeping firm like Candy's, to actually go out and actually do that, so that it is done on a consistent basis. Because that will save you a lot of money and time, a lot of chasing things around. When people get their bills
Hmm.
consistently, they pay them consistently.
Right. And you're top of mind, right? If you are, sending it out, right, as the project is ending and they know, terms are net 10 or net 5 or pay on receipt or whatever that is, then more often they're like, oh, yes, I need to send that in. But if you've waited a few months, then they're like, well, it's obviously not important to them. So I'll just put off, right, paying. And
Exactly.
often, I think when they first finally send the invoice out is like, oh, I really need the cash, right? And then the person who is receiving it's like, well, it's obviously not important to them to get paid, so it just
That's
causes
exactly
more
right.
of the effect, right? So
Yeah, or
yes.
even
Mhm.
the hidden thing is that some companies pay once a month. They maybe they're only paying on the 25th. And if your
Mhm.
invoice gets there on the 26th, well, guess what? You're not even going to be looked at for another 30 days before you get paid. And so that's why it's so important to understand the terms, understand everything in advance. But that consistency, like you're talking about, Candy, it's essential. You have to have
Mhm.
it.
Right. And we talked about watching your financial metrics, in terms of just financial management too, and understanding what's happening in your business, but also it's a key when you're looking at your sales. So do you want to talk about maybe some metrics that they could be watching in terms of their sales pipeline?
Yeah, with sales pipeline, I think that the important part there is that when you build your forecast, and everybody should have a forecast of some sort. No matter if you're $100,000 business or multi-million dollar business, and a sales forecast isn't just simply putting dollars beside something. It's really putting those non-financial information attached to the dollars. So, for instance, if you're a beautician, you're going to charge X amount of dollars per service. You're going to have X amount of services per day, and let's say that you've got 5 booths, times 5, maybe 4 of those booths are being used all the time. You should be able to figure out, hey, here's what I should have, coming down the pipe. Here's what my revenue should look like. And so you're creating that, what we call that sales forecast there. If you're a construction company and you know that, hey, I've got X amount of service contracts I'm dealing with on a regular basis, or if I've got one big project I'm coming through, I think it's really important to understand the concept behind the pipeline before you even look into the pipeline. So you've got to figure out, hey, here's how my business operates on the revenue side. Now, when I build my forecast, what I'm doing is I'm building it based on what I anticipate. So I think I'm going to get 5 jobs this month. I think they're going to be this long. Here's what the revenue should be based on that. And so I got this forward-looking concept. And then I look at my pipeline and say, hey, how strong is my pipeline? Here are the 5 contracts I'm talking about. Well, this one right here, it looks like it's going to get delayed a little bit. Well, make sure that you put that in your forecast. That's going to determine the timing of when you buy product for that project, if it's a product-based company. Or, this one looks like it's going to go quick. Or I typically add 3 projects a month that I don't even know about. So I've got to put some placeholders in there so that when I'm staffing it appropriately. And that could be 1, 2, 3 people. That could be a 10-person staff. It could be, if you're a bigger construction company or you've got, $1 million or whatever plus, you need to have that solid forecast. You need to understand the pipeline, what's coming in there. What I always prescribe to is I only put things in the pipeline that I'm pretty confident that's going to happen. So I would never put a wild card in there. So like if there's this great deal that I might get and there's a 2% chance or 10% chance or 20, I don't even include that in my analysis. I'm only looking for the ones that I feel that are what I consider hot leads that have a 70% or 80% chance of succession. And I put that in my pipeline as my buffers there. Those wild cards at the bottom, that usually fills up with the ones that I didn't know about or they didn't have a high likelihood that did come through. And so it's important to understand and create your own pipeline metrics, your own pipeline based on your company. And if you've had your company for over a couple, a year or 2 years or 3 years, you got a pretty good understanding on what clients will come through, what clients want, the type of client that does. And don't be the optimistic entrepreneur that thinks they're going to close every single deal because that's not going to happen. And that will lead you to destruction. So make sure that you're honest with yourself. If you need that third party to look at it, to give you an analysis, definitely take advantage of that. But don't be trapped within your own optimism.
I agree with that too. I've told people before too, like you can create what you think is going to happen, but then you probably do want to have a buffer because maybe your income isn't as high as you thought it was going to be, or, maybe there's some surprise expenses that you forgot to include. And so like creating it at first, but then adjusting it for kind of those other things. And like you said, definitely don't include something that is not really a for sure thing, because you could be like, oh yes, I think I'm going to get this one. And you plan your expenses around it. And all of a sudden, oops, we have a problem.
We've got a cabinet company, Candy, that we meet with on a regular basis. And the owner is super optimistic. I mean, he is the true optimist when it comes to an entrepreneur. And it's amazing all the different, because we list every single client out. Hey, here are the 10 clients that we're working with. Here's the amount of money we think we're going to get every single week, every single month, and whatever that might be. And it's amazing that the next month when we meet with the client, it's like, well, what about these 4? Well, they didn't work. It's like, well, I thought they were guarantees. It's like, no. And so as an accountant or as a bookkeeper, as whatever you want to call yourself, you're the financial steward, you've got to understand and recognize when a client is like that or when an entrepreneur is like that, is to make sure that you give them your honest opinion, your honest take. And so maybe it's, maybe that you're listing them all down. And for the ones that, then the simple question is, if any of these didn't happen, which ones would not happen? It's like, well, then it's the different question is, it changes it. Will they happen versus what the likelihood of them not happening? It's like, well, these 4 wouldn't. Okay, let's put these 4 in a bucket down here. Let's go ahead and take 50% on that one. So we're only looking at 50% pipeline on that, or you can discount it if you want to, or let's remove that from the conversation and put them down below. But you have to be, as a financial steward, you have to be able to recognize an entrepreneur. And as an entrepreneur, you've got to really kind of step outside the box and be true to yourself. And for those that don't fall within that 75-80% confidence ratio, you definitely need to move them below the bucket and not include them in your forecast. Otherwise, again, you will screw it up.
Well, we definitely want to be optimistic, right? But we need to also have some of that realistic
Yep.
expectation in there. And I think one of the things you can track over time is really looking at, well, how many prospects did you have? How many did you close? Like, what is your ratio,
Hmm.
right? So you can
Yep.
look at, well, this month we think we're going to have this many. Okay, great. So then according to past trends, you've closed 70% or something, and really using that
Yep.
metric. And you can still be
Hmm.
positive. And if you get more, great, right? Then you have, more cash and all of that, assuming that you're doing profitably on these jobs as well, right? But you have the money, but at least you're not counting on it and then it doesn't come through. And now you're in a bind because you're not going to have the cash flow that you thought you were going to have. And then, you're a little bit stressed. So, right.
Yeah.
Optimism is great, but realism is
Yeah, yeah,
important.
yeah, I agree because I am probably the most optimistic entrepreneur ever, and so I completely get it, and I hope everybody in the audience gets it too. And the big thing is that you touched on a point about your closing ratio, and I as an entrepreneur thought, hey, Mike, if I had an 80% or above closing ratio, that was awesome. In reality, it's probably not as awesome as you think, because what
Hmm.
that's probably telling you is that you're underpricing your service or your
Hmm.
product. And so it didn't really dawn on me until I had all these clients that were super low profitability. And so then it just allowed me to increase my prices to where I could start getting to a point where my closing ratio dropped from, it was 80% for a long time, to about 40%, or even between 30 and 40%. And at that point I realized, well, hey, now people are pushing back a little bit because of price, which is typically the reason why they won't go for you if they've reached out and they did their due diligence. And so that was a key for me. So once I got that 30 or 40%, that's when I knew that, hey, I'm probably now pricing my product correctly.
Hmm.
And I know that wasn't the topic, that a conversation that we had, but that was a huge eye opener for me, is that closing ratio. If it's too high, let's analyze it, and not powder, not pat ourselves on the shoulder. Let's look
Right.
at it and see, why is it high? Is it high
Hmm.
because I'm pricing it too low, which is probably the case. And if that's the case, let's increase our price until we can see that start dropping.
Right. And I think that's probably eye-opening for someone to actually hear you say that. Like, if you are closing a high percentage of your leads, you are probably not charging enough. Right. And so, do you want to give them maybe a tip on how they can go about figuring out where that should be in terms of their pricing, how to change that? Do they, go to their current clients as well and change it? Like, what would you suggest?
Yeah. So when we look at that, and I'm only going to tell you how I did it, because there's a lot of different ways to do it, and not every way is right or wrong. But the way that I did it is that we had set our price, and then we would look at that price all the time. So we're constantly managing that closing ratio in a monthly basis, and we're looking at a 12-month look all the time, not just simply that one month that we got 80% and then the next month we got zero. You're always looking at that 12-month. Make sure you have enough pits in there to make that adjustment. But once you actually start doing it, then the prices start increasing. So we would increase our price, and we'd always think, oh, we're going to lose clients, we're not going to pick enough clients up, and we'd realize, wow, our closing ratio didn't really drop at all. so
Hmm.
so then we're like, well, we're significantly. So then we continue increasing prices until we did see that 12-month look. And a lot of times it happens within a 6-month period. So between 6 to 12 month period, we saw the closing ratio drop. And so then the question is, now what do we do with our existing clients? Because we're charging, one person $500 a month, and we're charging another person $100 a month. How do we do that? And so now we've got that $400 gap between the two, $400 difference. And so, every year we always tell our clients we're going to increase our prices between 5 to 10% anyways. And the clients that we just picked up, well, they're closer to what we need to be price wise. And so we're going to increase our other clients gradually up. And they're
Hmm.
always going to get that 10% or 15% or whatever that bigger price is, until we can get them up to the level that we're currently pricing clients. Now that could take years, that could take months.
Hmm.
It could be really quick. Other people are like, hey, let's rip the bandage off completely and just make that big jump. And that's fine too. Either way is fine. Economically, that's probably the smarter way of doing it. Emotionally, it's probably the
Hmm.
hardest of the two doing it. So you got to kind of juggle that there. So if you want to bring your existing clients up to that price, I'm 100% for it. If emotionally it's harder, bring them gradually up. Make sure that they've got the biggest increase out of all clients until they get to that level. where they can level off and they can see that smaller increases. Now, will you lose clients by bringing them up? Of course you will. That goes without saying. Will it be as many as you think? No, not even close. Any price increase we've had, we've never lost more than maybe 5% of our clients. And when you think about that, if you're increasing your fees by 20% or 50% or whatever that might be, and you only lose 5% of your clients, you're benefiting significantly because now you've got more time to do work for the clients that are actually paying more money. And so that's the thing that we're looking at every single year, every single 6 months, whatever it is, we're always looking at it and saying, hey, where's our closing ratios at? Is it dropping now to 20%? Well, maybe we're too high. We need to lower the price of new clients and bring to get that. And then if that's the case, we have to make sure that we're still within our profit model in order to do that. But so it's an important thing you should always be looking at. It should always be fluent. And you should tell your clients from the very beginning that your price will go up every single year between 5 to 10% based on inflation. And, and it's no different than, you tell your employees they're going to get a raise every year anyways. Same thing with the clients. In order for you to give your employees a raise, you've got to increase your prices. It doesn't work. It works really poorly. The model doesn't work if you go one versus the other. And so it's important for clients to get in the habit from day one. And then, like for instance, the last couple of years, we've had to increase our fees, 18 to 20% a year. And that's not because we wanted to be greedy and we wanted to make a lot of money or whatever. It's because our employees demanded that. And so we had to give our employees similar pay increases. And unfortunately, as a business owner, you can't absorb it. So you've got to pass that on to the client. And that's unfortunate. That's the unfortunate way of economics, but it's something that as a business owner, you have to do.
Right. Well, I know that we barely scratched the surface of what we really could be talking about on this topic, but we're coming close to the end of the time we have together. So I would love to ask if you have an offer that you would like to share with our listeners, and if they have more questions and want to reach out, how they can connect with you.
Katie, I don't have an offer, but I guess the offer would be is that if anybody has any questions or would like to reach out, I'd be happy to schedule a 1-hour consultation and go not as a sales approach, but just simply answering questions they might have. And they can reach out with my email address. It's Jody, Jody, at summitcpa.net. I did the .net, not the .com. Couldn't afford the .net back then when .com when I was getting the website way back then, so .net. So it's Jody at summitcpa.net. I'd be happy to schedule a time where we can actually sit down and kind of walk through anything for a 1-hour period of time.
Perfect. Well, thank you so much for being a guest on my show and talking about this topic. I think it's important for entrepreneurs really to understand that they should be watching their finances and the things that they could be doing to make improvements in them. So I appreciate your expertise being shared today.
Yeah, thanks, Candy.
Thank you, listeners, for tuning in today. I hope you found this topic interesting and enjoyed the informative discussion. Would you please share my show with those you know and leave a review on your favorite podcast platform? I'd really appreciate your support. If you have any additional questions or comments, be sure to reach out to my guest at any of the links that they shared, or you could send me a message at media@abandp.com. I hope you can join me for my next interview. And remember, you can connect with me on Twitter, Facebook, and LinkedIn. And my website is abandp.com. This episode is sponsored by Affordable Bookkeeping and Payroll Services. If you are overwhelmed trying to handle the financial aspects of your business, ABP is here to help. Contact us today to discuss your needs at 310-534-5577 or contact@abandp.com. My team and I are eager to assist you. Until next time, have a great day.
Thank you for listening to Biz Help For You. Please join your host, Candy Messer, again next time. Have a terrific day.